Warren Buffett, a name that has become synonymous with investing success. Did you know that if you had invested just $1,000 in his company, Berkshire Hathaway, when he took it over, you'd be sitting on over $21 million today? But how did Warren Buffett become this successful? The answer lies in his investing principles. Hi, welcome to Taurus Treasury, and in this video, we'll be discussing the top 5 investing lessons we can learn from Warren Buffett. So let's dive in. 1. Invest in what you know. Warren Buffett, the legendary investor, has a simple yet powerful investing principle: invest in what you know. He emphasizes that investors should only put their money into companies that they understand, and that they should do thorough research and analysis before making any investment decisions. This principle is rooted in Buffett's belief that the best way to generate consistent returns is to invest in companies that have strong competitive advantages and a long-term outlook. By investing in companies that you know well, you can better understand their business models, competitive advantages, and potential risks. Buffett also stresses the importance of analyzing a company's financial statements, including its income statement, balance sheet, and cash flow statement, before investing. He looks for companies with strong earnings growth, low levels of debt, and consistent free cash flow. By following this principle, Buffett has been able to build a massive fortune by investing in companies like Coca-Cola, American Express, and Gillette. He has avoided investing in industries that he doesn't understand, such as technology, and has instead focused on industries that have a clear and predictable business model. Investing in what you know is not just a strategy for wealthy investors like Warren Buffett. It's a principle that anyone can apply, regardless of their level of experience or financial resources. By taking the time to understand the companies you invest in and doing your due diligence, you can increase your chances of generating consistent returns over the long term. So, if you want to become a successful investor like Warren Buffett, start by investing in what you know and doing thorough research before making any investment decisions. 2. Cash is never a good investment. This statement, "cash is never a good investment," might seem surprising to some, but it is rooted in Buffett's long-term investment philosophy and his belief in the power of compounding. Buffett believes that cash sitting idle in a bank account is a lost opportunity for growth. According to him, cash is not an asset, but a liability because it loses value over time due to inflation. He argues that when you keep cash, you are essentially betting against the economy's ability to create value, and history has proven this to be a losing bet in the long run. Buffett's investment philosophy is based on the idea of buying high-quality companies at a fair price and holding on to them for the long term. He believes that by investing in companies with strong fundamentals and competitive advantages, you can benefit from the power of compounding, which can lead to exponential returns over time. In his 2018 shareholder letter, Buffett wrote, "The goal of the non-professional should not be to pick winners. Neither he nor his helpers can do that, but should rather be to own a cross-section of businesses that in aggregate are bound to do well." This philosophy is in line with his belief that a well-diversified portfolio of stocks is a better investment than holding onto cash. Buffett's approach to investing has certainly paid off. Over the course of his career, he has consistently outperformed the market, and his company Berkshire Hathaway has grown to become one of the largest and most successful in the world. He has a net worth of over $100 billion and is often referred to as the Oracle of Omaha. Cash is never a good investment might seem counterintuitive, but it is rooted in his long-term investment philosophy and belief in the power of compounding. He believes that holding on to cash is a lost opportunity for growth, and that a well-diversified portfolio of stocks is a better investment over the long run. His success as an investor speaks for itself, and his advice is worth considering for anyone looking to grow their wealth over time. 3. Focus on fundamentals. Forget about trying to keep up with the latest fads and crazes in the stock market. Instead, take a cue from the legend himself, Warren Buffett, and focus on what really counts: a company's earnings, dividends, and cash flow. Sure, this might not sound like the most thrilling approach, but let's face it, chasing trends is a surefire way to burn out your investments and your wallet. By sticking to the basics and looking at a company's core performance, Buffett has consistently delivered stable and long-term returns for his investors. And let's not forget, this strategy has been the cornerstone of Buffett's success for decades. While others were jumping from one hot new thing to the next, Buffett stayed the course and built an empire that most of us can only dream of. So take it from the man himself and focus on the factors that matter most for your investments. Of course, focusing on fundamentals isn't always easy. It requires discipline and patience, as well as a willingness to do the research and analysis needed to truly understand a company. But in the end, Buffett believes that this approach is the key to successful investing, no matter what the market conditions may be. So, ignore the noise of the market and stay true to your principles, and you might just find that success is within reach. And as Warren Buffett once said, only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. 4. Play big, don't miss out on opportunities. One of Buffett's most famous quotes is, "Risk comes from not knowing what you're doing." This quote speaks to the idea that taking risks can be beneficial, but only if one has a solid understanding of the risks they are taking. Buffett believes that in order to play big, one must be knowledgeable and informed about the opportunities they pursue. Buffett's philosophy is based on the principle of taking calculated risks. He is a firm believer in the importance of being willing to take bold steps in order to achieve greatness, and he has consistently advocated for a go big or go home approach to business. For Buffett, the key to success lies in being able to identify and capitalize on opportunities that others have overlooked or dismissed. He has famously said, "Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble." This philosophy has served Buffett well throughout his career, and it is evident in his investment strategy. He has made some of his most significant investments during times of economic downturns, when other investors were too afraid to take risks. In 2008, when the global financial crisis was at its peak, Buffett invested $5 billion in Goldman Sachs, a move that paid off handsomely when the economy rebounded. Similarly, in 2020, when the COVID-19 pandemic caused the stock market to plummet, Buffett invested $10 billion in the oil industry, a move that he described as a bet on the American economy. To succeed in today's rapidly changing business landscape, you need to be able to think big and act boldly. So put your foot on the gas, look ahead, and play big to achieve the success you deserve. 5. Be patient and disciplined. Last but not the least lesson that we can learn from Warren Buffett's investing strategy is the importance of patience and discipline. Buffett firmly believes that successful investing requires discipline and a willingness to wait for the right opportunities to come along. This means that investors should avoid making impulsive decisions based on short-term market movements and instead focus on the long-term prospects of their investments. In today's fast-paced world, many investors are tempted to jump in and out of the market in search of quick profits. However, Buffett's approach emphasizes the value of patience and taking a long-term perspective. By avoiding the temptation to make rash decisions based on short-term fluctuations, investors can avoid costly mistakes and increase their chances of success. In addition to patience, Buffett's investing philosophy emphasizes the importance of discipline. This means sticking to a well-defined strategy and avoiding the urge to deviate from it based on emotion or external pressures. By maintaining a disciplined approach, investors can stay focused on their long-term goals and increase their chances of achieving them. In conclusion, the key takeaway from Warren Buffett's approach to investing is that patience and discipline are essential for success. By taking a long-term view and sticking to a well-defined strategy, investors can increase their chances of achieving their financial goals and building wealth over time. Thank you for joining us today. Don't forget to subscribe and leave your thoughts in the comment section below.